I'm Caroline Hyde in New York, and this is Bloomberg Technology. Coming up in the next hour, the FTX fallout, it continues. Sam Bankman-Fried steps down as CEO, laying out as well the timeline for his company's bankruptcy. We're going to dive into the implications for cryptocurrencies at large and the future of the underlying technology. Plus, Twitter suspended its $8 subscription program to combat a growing problem of user impersonating major brands. More on the revenue strategy in a moment. And the tech space is under a major restructuring. But you never know it looking at the markets. The Nasdaq 100 just notched its biggest two-day record run, up 9%, the best since 2008. Even though we see the Meta layoffs, even though we see Amazon looking at trimming its workforce, not to mention Disney just now. We'll get to all of that in but a moment. But first, let's get a look at the markets. I'm pleased to say that Emily is with us to just run through what was an enormous run-up in the last 2 days on the Nasdaq 100. What was it? The best 2 days since 2008?
Yeah, Caroline, best two-day gain for the Nasdaq 100 since 2008. And even today, you can see that outperformance in technology stocks against the S&P 500. And we had Amazon higher after they announced those cost-cutting measures, and also AMD outperforming the S&P 500. They unveiled new server chips that might help them sustain more market share against their competitor Intel. But there's less green on the screen when you look at cryptocurrencies. We had Bitcoin and Ether plunging further today. And FTT, this is FTX's utility token, we're looking at almost a 90% drop in the last 6 days. Of course, we know that FTX filed for Chapter 11 bankruptcy, and it's been a historic week. There's probably a lot more news to come when we're looking at cryptos, but really a lot of red there. And just summing up the week, though, we have seen a pretty nice equity rally here. Looking at the S&P 500, we're up about 6% on the week. All of that really related to the optimism of maybe the fact that we've reached peaked inflation. However, anyone skeptical of the rally, calling it maybe a bear market rally, points to the fact that we're really seeing the most speculative areas of the market, like the ARK Innovation ETF, outperforming. People say that when you see those speculative areas doing better, it means that maybe we're still in bear market territory. And just taking a look at Meta, best week for Meta since 2013 after they announced those layoffs. A much needed relief for that stock, Caroline.
Yeah, always slightly painful when shares rise after, of course, the cost cutting continues, but investors always seem to be liking that from a bottom line perspective. Emily Griffeo, we thank you so much. Meanwhile, let's stick with those markets. And in fact, let's stick with you, our audience, because we asked you to, amid the myriad of news that we're just hearing from Emily, the fact that we have these layoffs, the fact that we have FTX imploding, the fact that, of course, we still have this run up in stocks, what was the most important thing that caught your eye? You took to Twitter, you told us. No, it wasn't Twitter. No, it wasn't Meta. It was FTX bankruptcy. That is what rocked your world the most. Did it rock our own Katie Greifeld's world the most? Is it the biggest shocker for you, Katie?
It was the biggest shocker, I would say. I think back to who I was a week ago, last Friday.
A different person.
I was so young. I was so naive. I didn't know that FTX was on sale. If you had told me that we would see FTX, the crypto exchange, one of the biggest players in the space, file for bankruptcy, I would not have believed you. If you would have told me, too, that Bitcoin would be trading around $17,000 a coin after that, too, I wouldn't have believed it either. You obviously have seen a really rocky crypto market this week. Little bit of resilience, though. I don't know. We're not talking about 10,000. We're talking about 17,000.
And then, therefore, let's talk about the ripple effects, the contagion concerns, the issue that, therefore, we see across the rest of the markets, because that's sort of where we're going with this. The fact that, for once, the correlations broke down. Yes, you still have this shock and awe when it comes to FTX and the rest of the crypto sphere, but actually, that didn't hold back the Nasdaq. And was that something people were talking about?
Not at all. It's really, this is playing out in the most dramatic way possible in markets, in that on the upside, you have the Nasdaq 100, looking at one of its best weeks in years. Like you said, that headline at the top, its best two-day run since 2008. It's interesting because previously, until really this week, stocks and crypto were tied at the hip. It was the same exact trade, to really the detriment of the Bitcoin bulls, the crypto bulls that I would talk to. They would say this decoupling, when it happens from the equity market, it'll be such a relief for the crypto market. The decoupling happened. It was not bullish for crypto at all. And man, tech stocks just really ripping after that CPI report.
And what's interesting, though, of course, amid all of this is the concerns about the tech layoffs, is the issue of the fact that suddenly we're in a different paradigm right now, where companies that we thought were, no matter what, unstoppable, are now having to trim themselves. We're just getting the latest headline. It's the CNBC headline we know from Disney that they're looking at freezes, maybe even job cuts. We saw it from Meta, the biggest layoffs that we've ever seen in its history. Is that something that we should prepare ourselves more for? We've got yet further earnings next week, for example.
I mean, these are the type of headlines that are unfortunately pretty common when you have the Fed hiking so aggressively. This is the impact of tightening financial conditions. These are the sort of news events that we unfortunately have to get used to. And when you contrast that with what we're seeing in the markets, this really goes to show sort of the cold-blooded nature of markets, that forward-looking sort of stance of markets that, okay, when you start to see these type of headlines, when you start to see the impact of these Fed rate hikes, maybe that gets us closer to the end destination. And you pair that, again, with the CPI print that we got, a 7-handle, nothing to celebrate, but cooler than expected, that maybe gets us closer to the end destination, maybe closer to that pivot.
As I read from many, though, this market is kind of dangerous now. And the fact that Jonathan Golub himself, a real bull, saying, that was an overreaction, one to bear in mind as we digest the data that's still to come over the next week or so. Katie Greifeld, a different person from a week ago. We thank her so much. Meanwhile, sticking on the crypto fallout, let's talk about FTX. Let's talk about the rippling across the entire ecosystem here. Bloomberg's Emily Chang is with us on the story. I've seen your byline on every single piece of update that we've been having. You must be exhausted, but probably not as exhausted as a man whose wealth went from 16 billion to 0 this week. What is the next knock-on effect? What are we hearing and waiting for in terms of the news about the bankruptcy, for example?
Of course, the bankruptcy news itself is a huge shocker for the industry. No one has seen this coming. Me neither. When I started the week, I did not know this is how it's going to all pan out. We're starting to see some contagion effect coming out. We know that, for example, Voyager, which is a bankrupt lender earlier on that was supposed to be bailed out by FTX, they now had to restart their bidding process essentially because of this bankruptcy procedure for FTX. And then at the same time, even for big crypto market makers such as Genesis, they have money that's being trapped in their trading account on FTX, and then they had to get capital infusion from their parent group, DCG. So we're expecting to see more companies coming out to disclose the impact. And we know from the bankruptcy filing itself, at least for Alameda, there's 100,000 creditors listed, and their liabilities is at least to be over $10 billion. So the size and scope should not be understated. It is the biggest bankruptcy we're seeing this year.
Extraordinary, really. And therefore, the fall from grace of Sam Bankman-Fried himself, there will be movies written, there will be books, of course. The investigations that now continue into him and into what indeed has occurred, is that going to be happening at the same time frame as we do understand who the creditors are? Where do you think the bucks are going to stop dropping?
So for investigations, usually they're lagging behind, but we do know that U.S. regulators are investigating them. Whether the conclusion will come out soon, that's uncertain. And then Sam Bankman-Fried himself is also being investigated by the SEC, as we reported yesterday. So we're going to see a lot of angry customers, and as a result, a lot of angry regulators all over the world as well, just looking at the implications for this event.
As many say, the lawyers are really the only people that win in these scenarios. When you've had more than 5 million customers, that's going to be a torturous process of unfolding this. How many people are telling you at the moment that there are further counterparties to go, that there is further? We've already heard from the Sequoias of this world, for example, marking down their value, the overall holding to 0. We've already seen what SoftBank's implication was. Who are we worried about? Are we worried? You mentioned Genesis, for example.
So it is still too early to say who's going to be, which company is going to be the next one to fall completely. But I think there's one point that we should be hopefully more hopeful about for the industry, which is comparing to the event in April when the industry has a huge deleveraging event from the Terra collapse. The crypto industry today is much smaller than back then, and then a lot of the lenders have already delevered. So this is not the good news. It is a 1-2 punch, but at the same time, the industry is already downsized significantly from the beginning of the year.
Luna, Voyager, Celsius, FTX. I'm sure for many, they hope that there's some calming after that. Yang, we thank her so much for staying across what is an extraordinary story that continues to unfold. Meanwhile, coming up, another extraordinary story for you. Twitter suspending its subscription program because of too many fake accounts. We'll have all the details next. This is Bloomberg. Let's talk about Twitter. Suspending its $8 subscription program that was launched just earlier this week, that in an effort to combat a growing problem of users, of course, impersonating major brands, major people as well. It's all according to people familiar with the move at the moment, and I'm pleased to say across it all, and rather exhausted, is Alex Barinka. Thank you so much for joining us for a few moments, Alex. And just talk to us at the moment about what seems to be the U-turns that are going on. Is this sort of a startup culture once again, with the CEO just throwing things against a wall and seeing what sticks?
I think my neck and maybe a lot of others are hurting with all the whiplash we've seen already this week in the first week that Elon Musk has been at the helm of this business. This subscription move is one of those things. They rolled out this idea, this $8 subscription to get more users having this infamous blue check that used to signify veracity of an account and now has been impersonated by the likes of folks pretending to be drug maker Eli Lilly, saying insulin is now free. It's not, to government accounts of governments and politicians. So kind of a big uproar here because it all plays into the kind of proliferation of misinformation that we've seen on the platform before, that in a pre-Elon Musk world, Twitter really tried to lock down on. But in just 5 business days' time, it seems like the misinformation, whether it's in jest or more serious, has started to really play a bigger role on that platform.
And Alex, talk us through actually the irony of this proliferation of businesses that aren't actually those businesses getting these ticks is because Elon Musk himself wanted to move away from an advertising model because he was more concerned about those businesses not advertising because they're worried about the fake news factor and turning to a subscription model. But he's also been talking about other things within the business model, maybe becoming a checking account provider. I mean, what are we hearing from this man in the leadership levels right now about the direction of travel for the business?
Yeah, sources have told Bloomberg that they're looking for at least 50% of revenue to come from subscriptions. Elon Musk, remember, came from PayPal. He has talked about payments. Could you send money to people? Could we give everyone $10 to start having people send money to other people via the platform? So it seems like they're pushing some of these ideas really quickly. It seems like they're potentially pushing some of these ideas before they've thought through all of the implications with the blue check verification, the subscription issue being the lead one. Now, I want to underpin just how important this is for Elon Musk to figure out how to bring in more money and get this right. He told employees in the past 24 hours, he threw out the word bankruptcy. If we don't figure out how to make subscriptions work, the company could be in dire straits from a revenue perspective. So lots of pressure to figure out what is the thing, but it seems like kind of the darts they're throwing at the board really quickly this past week are not landing in a way that's keeping Twitter a place that people and brands and governments want to spend their time.
Alex, it's an emotive and a difficult question, but when I'm looking at Palmy Olson, our opinion writer over in London, who's saying that basically we might be watching Twitter implode in real time, and that some are kind of debating as to whether he's purposefully running this business into the ground, how many people are sort of echoing those concerns?
If you spend time on Twitter, you've seen that question posed in the context of, okay, he is very confidently talking about how he's going to change the platform and reignite free speech at the helm. But it was only weeks ago that he was saying he did not want to own this asset at all. So when you think about the $13 billion in debt that this company now has from being taken private, the 3,700 employees who were fired, who are now getting severance paid out, throwing around that idea of bankruptcy is something that, could be a knock-on of what could he do. I will remind you that Elon Musk with Tesla and SpaceX, in the context of those companies, he's also thrown out that B word of bankruptcy. Elon has proven himself not to be the typical CEO who maybe would avoid that for fear of stoking kind of bad fears within a company. But he has used this language before. So with him, perhaps there is a little bit of more of a wait and see if this is something that he truly believes, that the company is headed in that direction quickly, or if it is maybe his motivation tactic or something of that sort internally to get folks to figure out the next place to make some more money.
And make them do that from the office with no free food, which is just a minor detail in what is a very complex story. Alex Barinka, we thank you so much for the latest. And let's now continue this conversation from an e-commerce perspective as well, from a trust perspective. We've got a real expert for you. Rachel Tipograph, CEO and founder of MikMak. It's a global e-commerce enablement and analytics platform for multi-channel brands, huge brands that depend on you to understand where should I be putting my money to work when it comes to spending, to advertising, to social media. What are you seeing in terms of media traffic at the moment? What are your numbers telling you about how fearful they are of Twitter or how much it's useful for them at the moment?
Yeah, absolutely. I mean, right now I feel like we're living a movie about social media, and except this time it's a different platform. In the last 30 days, we've seen a 75% decline in Twitter traffic. 75%, of which 80% of that decline happened since October 27th, which is when Elon took ownership over Twitter.
And just talk through that traffic drop. What is that meaning? That is meaning that, the companies that you're talking to just don't want to be anywhere near affiliated. They're not posting on it. They're not putting out their products on it, or it's more people aren't interacting with them because they're so distracted by other things that are on the platform right now.
Yeah, so at MikMak, we get trafficked through national digital media across all major social platforms. And so when we see a decline in traffic, it means that ad spend is being paused.
Okay.
The thing about advertising is that it's very easy to turn on and off. And so while things are so volatile right now, it's better for advertisers to take a back seat than expose their brand reputation.
I was just speaking with the Amex CEO, Steve Squeri, yesterday, and he was talking about how where they put their money to work on a marketing perspective has to reflect their values. And this is what a lot of companies are doing, why General Mills are pulling back on Twitter and why we've heard GM do the same. Some thought about competition there too. But I'm interested this is also an environment, a recessionary environment, a slowing down economically environment, where people might be pressing pause everywhere. Is that the case, or is this really idiosyncratic?
It's actually not the case. Right now, it's November and December, Q4. This is when 60% of media spend normally happens.
Okay.
So we're seeing spend happen on Meta, on Snap, on Pinterest, on TikTok, on Google. People are spending. But spend is now being reallocated outside of Twitter into these other channels.
And where's benefiting the most? I have a feeling I can guess.
You could probably guess, but in the last 7 days, we've seen a 20% increase in TikTok traffic.
Oh, wow. And is that, today, just me, I was on TikTok and suddenly I found myself basically perusing some athleisure brand because it's Singles Day. And then I didn't even realize I was doing it native within that overall app until I'd clicked out of it and didn't actually buy what I was going to buy. But I'm interested as to, is it because we're in that particular months or is it actually a different reason?
No, TikTok is inherently personalized. Yeah. It probably scares you how well the app knows you. And so when you open TikTok, right there and then, they have a high consideration knowing what you want to buy. We actually see amazing conversion on that platform. And unlike other social platforms, you can get huge bang for your buck organically or being influencers. Most of the other social platforms, you have to pay to play.
And a lot of people have been sort of wringing their hands about the noise that has been built into the system. Many lay blame, a lot of CEOs would like to lay blame at Apple's feet as to how perhaps some of the direct targeting has become less direct, less efficient in that respect, and probably harder for some of your clients. I'm interested in general, are you seeing at this moment, what are your clients wanting to do? Are they wanting to have more effective, efficient use of social media? Are they backing away entirely? What are they saying to you?
Yeah, changes in iOS 14 have really undone brand media as we know it. Platforms like Meta used to be an amazing conversion channel. But ever since the changes that Apple made, all of a sudden you're seeing spend shift out of national brand channels into environments like retail media. If you look at Amazon's most recent earnings, advertising grew 25% quarter over quarter. There's really strong ROI within those environments, as well as brand safety. You don't have to worry about issues like you're experiencing in Twitter in an environment like Amazon.
Okay, and I love that you bring us back to the brand safety element. Is there anything in the here and the now that will change that 80% drop, do you think, for Twitter traffic?
Yeah, this is not the first time a moment like this happened. In 2017, brands paused on YouTube because of hate speech. In summer of 2020, brands paused on Facebook because of hate speech. Both of those platforms inevitably regained the trust of advertisers, but what it took was the corporate executive team going from conference room to conference room and showing that they can stabilize their platform and deliver on their words. So I don't think this has to be a forever thing for Twitter, but what the industry needs to see is stability, and they need to see action, not words.
Well, we thank you for your words. We thank you for coming in the studio as well. Such a great voice. Rachel Tipograph, of course, founder and CEO of MikMak. Meanwhile, we're going to be right back with more on Bloomberg Technology. After this break, we're going to be talking so much more about the layoffs in particular across the sector. Stay with us. This is Bloomberg. SoftBank founder Masayoshi Son says he will no longer speak at earnings presentations he's led for decades. That's after the company's Vision Fund, of course the arm that is doing a lot of investing, had a $7.2 billion quarterly loss due to the write-downs on its tech investments. Now, SoftBank, which for years was the world's most aggressive tech investor, has virtually halted new investments and focused instead on its balance sheet. Meanwhile, Alibaba decided not to disclose full sales results for its signature Singles' Day shopping festival. And that's for the first time ever. Alibaba said in a statement that the gross merchandise value was in line with last year's GMV performance, despite macro challenges and COVID-related impact. But some forecasts say, look, the figure could suffer a decline that's unprecedented in the event's 14-year history. Coming up, well, let's talk about the metaverse. Is it here to stay? Is the hype for real? And what about, of course, the here and the now for you in real life? What about your job? What about layoffs in the tech space? We're going to be talking about that and so many more trends within technology with Activate founder and CEO, you know him as Michael Wolff, MTV, a management consultant of old, of course. We'll get his insights. This is Bloomberg.
I think this is the first of many cuts that we're going to see, not only for these companies, okay, but companies writ large. We've seen over hiring, over inventorying, over ordering, and that all has to get wrung out of the system. These companies are starting to take action, right? Finally, and that's a positive.
This is Bloomberg Technology. I'm Caroline Hyde in New York. You were just hearing from Mike Wilson, Morgan Stanley's chief US equity strategist, about the current landscape of tech layoffs. And let's dig into that a little bit more, plus much other conversation topics to be having with the Activate founder and CEO, Michael Wolff, management consultant, previously COO and president of MTV. He was also on the boards of companies such as Yahoo, for example. You're a man who understands what it's like to run businesses, to have to slim down businesses, to see a restructuring. What do you make of not only Disney now saying that they're going to be cutting their jobs, freezing hiring, only essential travel? We heard from Meta, the artist formerly known as Facebook, but Meta, 11,000 jobs to go. These are significant cuts.
There are a lot of other companies, Stripe, Lyft. There's so many of these companies are using this moment. But if you look at the numbers, in a lot of ways, they overshot. Mm-hmm. They expected that the growth that they experienced during the pandemic would be sustained. So if you look at what's happened with Meta in 2017 had 25,000 employees. 2019, they had 50,000. After the cuts, after the 11,000 cuts, they're still going to be at 75,000 employees. So this is just going back to yesterday a little bit. And it's also a moment in which they need to say to their investors, we're going to focus on profitability and recognize the realities of the web.
I think what's interesting is also the manner in which these are being announced. To his credit, Mark Zuckerberg had a mea culpa moment. He said it was his personal responsibility. You've seen that echoed by other leaders as well, and whether or not it's more previously, Shopify was almost the first company to really announce that really they'd got the trajectory wrong. They'd got the COVID lift and they thought they could bring it into perpetuity, and actually no, the arc was going to fall back down a little bit. Then on the other side, you have an Elon Musk who is doing it without much emotion. How do you as a business leader, as a management consultant, think about the way in which these messages are delivered?
Well, overall in the tech business, we're losing about 100,000 jobs from those companies. But also, if you look at it from the perspective of the overall market, all those people are going to find other jobs. There's a tremendous amount of demand for technology talent in everything from finance to government to healthcare. And even in startups, there's about $250 billion in venture capital out there waiting to be deployed. But when you look at these companies and you think about where their cuts are going to come from and what they need to do, the bigger issue is they've got to find new sources of growth. In every one of these cases, from Apple to Amazon to Meta, they're all dependent on the old sources of growth. And by the way, that's why they're coming to our company Activate, because they're looking for new places for growth. Cost has a huge human toll, but it's actually much more difficult than growth.
Okay, so let's talk about the growth that hopefully some of these people who are now getting, we hope, decent severance packages and able to go and set up their own startups, or indeed a Meta that now doubling down on the continued trajectory of a different kind of growth, a focus on a Web3, let's call it. You're, of course, the man who puts together the future analysis. You're putting together what 2023 is going to look like for us. Is Meta the right bet?
The challenge is Meta's metaverse bet is all about virtual reality. And what's happened overall with metaverse is we're already past the hype cycle. I mean, we've already hit the peak of hype, and now we are going to see sustained investment. But the sustained investment may not be in the places that Meta is focused. So, for example, the metaverse doesn't necessarily mean virtual reality, not necessarily a virtual reality headset. In fact, our research shows that most people don't spend more than 30 minutes at any one time in virtual reality. So a lot of it's going to be 2D, and a lot of it's going to start in video games. And in fact, when you look at the metaverse, you have between 4 video games, between Roblox, Fortnite, Minecraft, you end up having 300 million people who are spending a great deal of their lives, on average 11 hours a month, and some of them are spending 40 hours a week in these games. And they're all metaverse platforms. So the idea that this is way off in the future, and none of it is spending time with an Oculus headset. So it depends. Every company is going to take a different bet. It just may not necessarily be the right bet.
What you mentioned Roblox, and what Roblox sort of for many helped with this whole idea of a metaverse. We could then see, that's maybe where crypto comes in. That's maybe where the payment, when you're buying skins and the like, suddenly you have a native currency, you have a digital currency, for want of a better expression. When we're starting to see the fallout that we've just done with FTX, with crypto in general, is that going to impact the metaverse, Web3, the direction of travel in any way?
Well, actually, the payments that are taking place inside of those large metaverse platforms, they're not crypto. And when people look at metaverse, they think Web3 and metaverse are the same thing. In a lot of ways, they're not. Web3 depends on really decentralized protocols, crypto. And metaverse is really the consumer layer. So in the same way that we saw the browser was necessary for the internet, metaverse is going to be necessary for Web3, but we're way far off in seeing the applications of these technologies in Web3.
Okay.
And what's happened even today with FTX shows that that the tools may be valuable, but their application is going to take a while to be applied.
So therefore, when hiring, if ever, I mean, at the moment, is the workforce in the right space? And these big companies that are coming to you for ideas for growth, have they got the right resource and the right talent? Are they letting go of the wrong people, for example?
Well, there's an old saying that the technology company with the best technologists wins. And they're keeping the people that they need, the people with unique skills. But a number of those people with those skills, whether it's AI or it's creating unique environments, those people are going to go to other places. And we're going to see, just like we've seen in different waves of technology, they'll go other places and they'll start new businesses. Yeah. And so one of the keys for each of these companies is going to be able to figure out where they're going to experience growth, where the growth opportunities are going to be, and then aligning the people that they have around those areas, and also quickly moving out of areas where they don't see growth in the future.
The Pivot Activate founder and CEO Michael Wolff, come back when you are talking to, of course, all these businesses looking for that steer. We thank him for it. Meanwhile, coming up after the FTX blow up, where is crypto going? Where's the underlying technology going? Stick with us to dissect. This is Bloomberg.
We have, a few billion on our balance sheet right now. We are profitable. We're in a relatively strong place from a financial perspective.
I want to be doing something net positive, like with the making money part. I want to be a good actor there.
We've raised a few $1 billion over the course of the last couple of years, and we're a profitable business. And with Voyager, I think there's $70 million there that we put in that I'm not sure we're ever seeing that $70 million again. We've not used the majority of the cash that we have on our balance sheet. We want to be flexible. We want to be in a position where we are, looking forward at, what we can be doing, where we can be most helpful, and where we can grow the most. I'm excited about Pathway Forward. I'm really excited about our leadership.
Wow, the FTX co-founder, former CEO Sam Bankman-Fried, talking to Bloomberg again and again about profitability, about growth, in a series of interviews, in fact, from July to September of this very year, and then the downfall that we've just seen, the unraveling in 1 week, and one that perhaps was slightly more prophesized by our next guest, Mike Alfred, Eaglebrook Advisors founding board member, of course, a man who's deeply working within the world of crypto. He also happened to be a value investor, so a man who can give us takes on whether you should be in AB InBev at the same time as whether you should be into certain cryptocurrencies. And Mike, first and foremost, why were you concerned, or were you concerned about the closeness, shall we say, of Alameda and indeed of what was happening at FTX?
So I was concerned about a lot of things over the last 2 years in this space, right? So I think there's a couple of really big fundamental issues here. One is just a lack of corporate governance, right? So FTX basically had no outside investors on their board. Many of these other companies that blew up this year had similar setups where, because they had so much leverage when they were raising money, there was nobody who could tell them what to do. Right? Then there's a lot of leverage, right? You don't see blowups like this without a tremendous amount of leverage, right? That's going to typically be there in every situation. And then the last piece is just this overreach for yield in a low interest rate environment, right? So all of these firms are essentially doing these sort of poorly structured arbitrage trades. And so if you look back to the spring of 2021, the grayscale arbitrage trade, who was in that trade? 3AC, Celsius, BlockFi, right? When you look at Terra Luna, that was also an arbitrage trade. Borrow money from a trading desk at 10% to get 20% in Anchor. Who was in that trade? Again, 3AC, Celsius, and of course FTX. And so FTX blows up, and indirectly, it's because of the relationship with Alameda, right? Because Alameda essentially lost so much money in that Anchor trade that they needed to paper over it. And that's where Sam crossed that bright line, right? Because up until that point, it was just gambling with the principal's money, in a sense. Yeah. But once he started gambling with the actual users' money at FTX, I think that's when things really went downhill.
5 million users, but also a proliferation of high-profile celebrities, of thought of and deep-pocketed venture capitalists have now been burnt and I'm sure incredibly angry at. Mike, what next in terms of credibility? Because as you've just been mentioning, the names, you've had Luna, Voyager, Celsius, you then have FTX. Is there another shoe to drop here? Is there a contagion risk? Is there other people that will be so badly burnt that there has to be further to fall?
So eventually there won't be any contagion risk, but obviously those of us who felt the contagion was mostly contained in June after Celsius were wrong. Remember at that time, SBF went on your program and a number of others and said, look, this is over, right? There's not going to be any more downside. And in retrospect, he was clearly doing that to protect his own firm's liquidation levels. He wasn't doing it because he actually believed it. He wasn't doing it to be JP Morgan. He wasn't trying to save everybody. He literally was just protecting his own ass. And I get why he was doing that now, but I should have read kind of deeper into it and realized, okay, he probably has the same problems in his balance sheet. So roll forward to today, who could actually have more risk in their balance sheet than we know of? The one firm I can think of is Binance. And that's not a popular opinion. There are a lot of people who want to believe that Binance is a good actor, but the reality is they're an offshore exchange that's thinly regulated, just like FTX. They don't even have a domicile, so it's hard to hold them accountable for anything. And I'm sure and I'm certain that in some ways they're engaging in similar activities on the back end. So that would be the ultimate blow up if something would happen to Binance.
Well, of course, we'll go to Binance to try and get their take and have them be able to defend themselves, CZ in particular. But there is an interesting take there that this is the centralization of ultimately what is wanting to be decentralized. Is there a way that you can have centralization other than perhaps a company that is public, that is regulated? How do you regulate non-public, non-US domiciled companies? Is there a way we can bring transparency, the promise of real transparency that so excited many about this space? Can we ensure that that is happening when you do have these deep pockets and indeed a level of hiding behind certain arbitrages?
I mean, I think there's sort of two ways. One is to just stick with a very safe, regulated onshore exchange that holds all the assets one-to-one, doesn't lend them out, doesn't run a hedge fund in the background like FTX or Celsius, or go all the way to the other side into true decentralization and leverage DeFi protocols that are using code to offer these services, right? So Uniswap and Maker and Compound, I think it needs to be noted that when you look back at what happened during the period where Celsius was being liquidated, those protocols did a good job, right? They liquidated the counterparties immediately, no questions asked. They didn't care who you were. They didn't do any credit check. They didn't call you and say, please, sir, deposit more collateral. They just did the job that was written into the protocol. And so I think truly decentralized DeFi could work at scale and may actually be better in most cases to a centralized option. But if in the meantime, while we're waiting for that to happen, using a company like Coinbase in the US is one of the safest ways to approach it.
Let's talk a little bit about what regulation happens from now, Mike, because I'm pretty sure there's a lot of sharpening of pencils going on at the moment, because in many ways, Sam Bankman-Fried himself was seen as the main lobbyist out there talking, and maybe have been his undoing in many ways when it comes to the relationship that disintegrated between himself and CZ because of that lobbying. But I'm interested when actually in the clear light of day, in real TradFi, traditional finance, you still get these blow-ups. You still have Archegos, you still have Bill Hwang, you still have, goodness, a liquidity issue that happened just a month or so ago in the UK with its pension funds because of issues within the holdings of bonds and the movement. Even in deeply regulated markets, we can sometimes have these desperate affairs. How do we make regulation fit for purpose within crypto at the moment?
So it's a tough question. But if you look at like MF Global, right? They went into bankruptcy and it took a little bit of time, but none of the sort of users of that platform lost any money. Same thing with other brokerage platforms, other banks. The regulation is so stringent and there's so many protections that it's really hard for an end customer to lose all their money. And so, look, I mean, that sort of regulation may stifle some innovation, but it also stops casual retail users from losing everything. And so I would err on the side of being more conservative generally. I don't think it makes sense to allow people to lever up 10x, 20x, 30x. I don't think it makes sense for these platforms to take the money on the back end and essentially gamble with it. And so if that means less innovation, I'm sort of okay with that.
And interestingly, of course, the innovation, the froth, the money that poured in has sort of been pulled out. And it's almost a year exactly since Bitcoin was at 69,000 and then since to today when FTX is unraveling. Can you call a bottom in this market? What do we need to instill some sort of trust back to in the relative space of other cryptocurrencies out there?
I think the most important thing, once again, is that there's not going to be any taxpayer-funded government bailouts here. And I think that will give people confidence once it's clear that there's no more dominoes left to fall. And I think in the coming days and weeks, as we look at the creditors to FTX, which they're just going to be numerous, companies like BlockFi, et cetera, that BlockFi is probably going to file for bankruptcy imminently here. I've heard they've already hired counsel today, which makes sense. I sort of said that on Twitter 2 days ago, that you should pull your money off BlockFi because that was sort of an inevitable consequence of this. Look, it's going to take a little bit of time, but sometime in Q1, Q2 of this coming year, there's going to be a wonderful, potentially generational opportunity to buy Bitcoin. And when I say just buy Bitcoin, I mean Bitcoin in cold storage where there's no counterparty, where there's no risk that you lose all your Bitcoin, because Bitcoin's a wonderful thing on its own. It's what we're talking about is all the adjacent centralized businesses that took on too much leverage, that were often unregulated and they were offshore and they messed up. And that happens in these sort of Wild West environments. But Bitcoin itself is still going to make a new block every 10 minutes for the next 100, 200, 500 years. That's what we're betting on in the Bitcoin space. And if that comes true, it doesn't matter what happens to any of these companies.
Oh, we'll hear from the Bitcoin maximalists and more, but I'm not calling you one of those. But it's interesting that we'll once again go back to perhaps where people feel that they can trust for the time being. Mike Alfred, really great to have some time with you. Thank you. Eaglebrook Advisors, founding board member, of course, all about institutional access to some of these DeFi protocols. Well, I actually got to speak with a key CEO in the traditional finance space, American Express CEO Steve Squeri, just yesterday, and talked about the fallout of crypto at the moment and whether or not it could still be an innovative space to be investing in, whether traditional payment methods could be disrupted through it. I spoke exclusively with him at the Economic Club of New York yesterday. Take a listen.
We've looked at cryptocurrencies from when they first, started to gain traction. We've experimented with blockchain. We've got investments in blockchain companies. We have a partnership with Abra where people earn cryptocurrency rewards. And, I've been pretty public that I believe that cryptocurrency is an asset class. And I think people like to invest in different asset classes and off you go. But I don't see it replacing the payment rails. And when I think about cryptocurrencies, I put that under the umbrella of digital currencies. And so I have, you have digital currencies. You have the cryptocurrencies, your Bitcoins, your Ethereum, and so forth. And then you've got your stable coins. And then you've got, governmental digital currencies as well. And I think there certainly is a play for digital currency in the economy. But it's hard for me to see right now cryptocurrencies with the volatility, with the limited supply of some of them as well, how it really replaces the traditional payment methods. The one thing with the traditional payments methods, they're not broken. They work. So we'll see. Having said that, you never say never. And that's why you stay engaged, you listen to people. There's a lot of people that have a very different perspective than I have, and they've made a lot of money. They may be a lot smarter. But I think when I think about sort of the business that American Express is in, which is we're really a lifestyles brand that brings people experiences, provides access, and combines a payment facility with that, the horses that we have right now are working for us.
Coming up, it was a wild, wild week for investors, for news consumers, and the week ahead could be pretty busy too. Stick with us. This is Bloomberg. So maybe, just maybe, we get a bit of calm in the week ahead. Let's have a quick look at what we're actually covering. What's already on the agenda? We know that there might be some headlines we're not expecting, but there could be some fireworks when it comes to the Epic versus Apple trial. Monday, of course, a key focus there. We're going to be digging into key earnings of large mega brands such as Walmart. Of course, we're going to get a real sense check on where the retail, where the consumer is at, but also where they're shopping online, how digital spend is going at the moment. Of course, Nvidia front and center when we're thinking of US-China relations, when we're thinking of chips, when we're thinking of the semiconductor space at the moment. moment, and well, whether we are in some sort of mega cycle once again. And Airbnb CEO Brian Chesky is going to be joining Bloomberg on Thursday. You want to be tuning into that exclusive conversation. And then, of course, back to the courts come Friday. Elizabeth Holmes, the sentencing, the Theranos trial. You do not want to be missing that as we deep dive. So much more, of course, coming to Bloomberg. I'm pleased to say, of course, on Monday, we're going to have Sunny Singh, one of FTX's investors from their funding round back in 2020. Just how painful has that trade been? What does he think of the future? Check out our podcast as well. You can get it on Apple, Spotify, and iHeart. Have a good weekend. This is Bloomberg.